Before we begin, this video is made for educational purposes only. The information discussed here is summarized from trusted financial media, including CNBC Indonesia. According to CNBC Indonesia's latest report, the crypto market is entering a critical phase tonight as volatility is expected to peak. This means price movements could become faster and more extreme than usual. Bitcoin and Ethereum are facing strong selling pressure, while many altcoins are also moving lower. This situation reflects growing uncertainty in the market, where investors are becoming more cautious. High volatility often appears when the market is deciding its next major direction. In conditions like this, even small news or data releases can trigger sharp price movements. This is not about panic, but about understanding risk. During high volatility periods, discipline and risk management matter more than bold moves. And as always, this is not financial advice. Tonight, we're taking a closer look at recent crypto market action, where major digital assets face sharp declines and significant value was wiped out, highlighting ongoing volatility in the space. On December 16th, both Bitcoin and Ethereum experienced notable losses in a single trading day. Bitcoin fell roughly 4.5%, while Ethereum dipped nearly 7%, a clear sign of heightened selling pressure across the market. These drops didn't happen in isolation. Instead, a large portion of the market's downturn was driven by what's known as forced liquidations, automatic sell-offs triggered when leveraged positions are wiped out due to falling prices. In total, nearly $592 million in positions were liquidated during this move, which added momentum to the downward pressure. When leveraged traders are forced out, their assets hit the market all at once, often accelerating declines. This kind of event underscores a key risk in crypto markets. Leverage amplifies both gains and losses. When prices swing sharply, traders using borrowed capital face rapid liquidation, and that in turn increases volatility even further. It's also a reminder that price action isn't just about technical charts. Market mechanics like liquidations, leverage, and trader behavior play a major role in how quickly prices can move. So, when you see headlines about Bitcoin and Ethereum dropping several percent in a day, remember that forced selling can be a big part of the story, especially during periods of market stress. As global markets remain on edge, traders are turning more defensive, and the US dollar is once again in focus. According to Reuters, investors are closely watching delayed US jobs data, which has increased uncertainty across financial markets. When key economic data is postponed, traders often reduce risk exposure and move towards safer assets, such as the US dollar. This defensive positioning has strengthened the dollar, while putting pressure on risk-sensitive assets, including crypto. For crypto markets, this matters more than many realize. A stronger dollar typically signals tighter financial conditions, making speculative assets less attractive in the short term. As capital flows into the dollar, liquidity in high-risk markets can dry up. This often results in increased volatility, sharper price swings, and sudden sell-offs, exactly what we've been seeing in recent crypto market movements. The key takeaway here is simple. Crypto volatility is not happening in isolation. It is closely linked to global macroeconomic conditions, investor sentiment, and expectations around US economic data. Periods like this reward patience, discipline, and proper risk management, not emotional decisions. If you find this macro crypto breakdown helpful, make sure to like the video and subscribe for more clear, data-driven market insights. Share your thoughts in the comments. How do you think global macro conditions will affect crypto next? And as always, this is not financial advice.